Hello, welcome on board AFM Advanced Financial Management. I'm Rashad Hussain, your expert tutor for AFM. This is a debrief of question Fulftig company from AFM mock examination. We're about to embark on a journey through a mock debrief for the Fulftig company question. This is a 25 mark question, including 5 professional mark. Pay close attention to those professional mark. They are your secret sauce that can significantly boost your overall score. This question is on an exciting topic. Which one is it? It's none other than APV, adjusted present value, and it also covers factors influencing credit rating along with 5 professional marks. Now, I know it might sound a bit challenging, but trust me, it's going to be worth it. If you haven't attempted this question before watching this video, you're highly recommended to pause the video and attempt it and then get back to compare your answers. So now buckle up and get ready because this mock debrief is your ticket to mastering the essential concepts and techniques like a pro. So let's jump in. First, let's look into the essential concepts to be an APV pro. Now let's try to understand the difference between an NPV, a net present value, and the adjusted present value. So as far as net present value is concerned, here the cash flows are discounted at what? At WAC in order to find out the NPV. If that NPV is positive, we shall accept the project. If that NPV is negative, we shall reject the project. Whereas, as far as APV is concerned, the adjusted present value is concerned, it has got two parts. One, the normal cash flows, and the other one, the financing effect. Here, the normal cash flows are discounted with something not with WAC. It is discounted with something called KEI, cost of ungeared equity. What is this cost of ungeared equity? So KEI is equal to RF plus, how do we find KEI? K is equal to RF plus beta, not the normal beta, not beta equity. It is going to be beta asset into RM minus RFY. Beta asset is assumed to only reflect the business risk. It does not reflect financial risk. So we are only looking into the business risk element, and the financing side effects are considered separately. Now, how do we find out this beta set? The beta set is equal to beta equity into value of equity divided by value of equity plus value of debt into 1 minus tax. So using this beta asset into the CAPM formula, we get this thing called ungeared cost of equity. Using ungeared cost of equity, the cash flows are discounted to find out something new that is called as the base case NPV. This base case NPV can either be positive or negative. Under the financing side effects, as far as interest is concerned, we are first going to find out what is it, the tax saving on interest. This tax savings on interest is to be discounted. The interest is, yeah, the debt is assumed to be risk free. It is supposed to be discounted at risk free or KD, the cost of debt. And what we get from here is called as the present value of tax savings or tax shield on interest, which is again going to be positive. The second part of financing is that we might have certain debt which is at subsidized rate, which is the we've got the subsidized loan, and on that subsidized loan we tend to save interest. So the interest that is saved less on the interest that we have saved, what we lose the tax relief or we lose the tax shield. So tax relief lost. is supposed to be discounted at a gain. It's considered to be risk free. That is considered to be risk free, either RF or KD. We find out what is called as present value of after tax interest subsidy benefit. Interest subsidy benefit, which is again going to be positive. And the last part of the financing is the issue cost, which, since it happens in year zero, it's not going to be discounted, but we convert it into post tax, we adjust it for tax. So we're going to have post tax issue cost, and issue cost is always negative. And once we consider all these four cash flows, all these four present values, we get something called as APV. If this APV is positive, we are going to accept the project. If it is negative, we are going to reject this project. So, using this basic concept, now let's head into this question. Fulftig company has got two exhibits, requirements, and two response options: word processor and the spreadsheet. Let's read the exhibits. No, that is not the approach. You're not supposed to start with the exhibits. You're supposed to start with the requirements. And let's have a look at the requirements. We've got the requirements here. And even before you read the requirements, it's recommended to have that requirements into the copy pasted into the word processor and the spreadsheet. The first requirement is about to calculate, and it would be recommended to have that requirement in the spreadsheet. So let's have this requirement A copy pasted into the spreadsheet. It is about to it's about to calculate APV, and the second requirement is about discussing, is to discuss, and let's have that in the word processor and just line it up. The second requirement is to discuss about the factors that are going to influence credit rating. Now let's head into the exhibits. The exhibit 1 is about Fulftig company, and it mentions that the company was listed 2 years ago. There is an increase in the number of shares. Further, the question also specifies that the institutional investors want the directors to invest in new projects and new markets. For this, the CEO, the chief executive, he believes that the company should make use of its existing credit rating and issue loan notes. Further, the exhibit 2 mentions the project requires an immediate expenditure of 160 million and working capital of 20 million, and this working capital is going to increase annually at the start of year 2 to 4. The expected inflation rates of working capital is given, and is also mentioned that the working capital is fully recovered at the end of year 4. So let's start off with the working note on working capital. So it's going to be the calculation of working capital cash flows. And the year 0, 1, 2, 3, 4. First, going to get the working capital that is required. It is going to be 20 million. So let's have here that the amount is in dollar million. And then this requirement is going to increase by 8 percentage for the second year, going to increase by 7 percentage for the third year, and further going to increase by 5 percentage for the fourth year, arriving at the incremental working capital, initially investing 20 million and then investing only the excess that is required, which is 1.6, and further excess of 1.512, and the final year excess that is required is 1.1556. Arriving at the working capital cash flows, which is always required 1 year in advance. It is required at the beginning of the year, so to be placed 1 year ahead, and it is always assumed that the working capital is fully recovered at the end. So this is going to be the note as far as calculation of working capital is concerned. Now, moving to the next part of the exhibit, where the finance director has used a time horizon of 4 years and has forecast the following post tax cash flows from the investment. And now we can use these post tax cash flows of year one, two, three, four to arrive at, yes, what is it? Not the normal NPV. We need to calculate the base case NPV. Now, in order to calculate the base case NPV, we need, what is it, the cost of equity, the ungeared cost of equity. So the ungeared cost of equity is required, and using that, working note number two should be about calculating what is it, the base case NPV. Now for the base case NPV, the year 0, 1, 2, 3, 4, we are already provided with post tax cash flows, and picking it from the question, which is 32.4, 52.7, 66.9, and 56.4. Picked the post-tax cash flows. And what are we incorporating here? What more? Yes, we need to incorporate the working capital cash flows, which could be picked up from the above working note. And let's read the question to find out the initial investment as well. The realizable value of the investment can be assumed to be zero. The question further states about, what is it, the financing package, and it's about the equity issues there. Its bank loan is there, subsidized loan is there, and further the initial investment has specified at the beginning of the question, initial investment, which is 160 million. So using all these cash flows, we can arrive at the total cash flows. And in order to find out the base case NPV, we yet need, what is it? We yet need to get the ungeared cost of equity. So let's read. Issue cost is specified as 2% of gross proceeds, and that issue cost is there on equity and subsidized loan. It is not there on the bank loan. And there is a tax rate at the rate of 20% specified. Taxes payable in the same year as profit on which it is based. The finance director intends to use adjusted present value evaluating the investment financially. He has calculated all equity financed discount rate at what, 12%. So it's directly given. The ungeared cost of equity is given as, what is it, 12%. The ungeared cost of equity is given as 12%. I can use that in order to find out, yes, the base case NPV. So the NPV is equal to 12%. Pick up the cash flows from year 2 onwards to 4, and for the NPV, add year 0 to it. We need to reduce year 0. Year 0 being a negative cash flow, just add it up. Will give you a base case NPV of negative 13.63 million. So the most important thing in order to fetch the mark is writing the comment. What is it? The base case NPV. The base case NPV is how much it is? Dollar 13 is negative. Yeah, we'll mention it. Negative dollar 13.63 million. And on this basis, Hmm? Spaces. What is it? The investment should be rejected. But do we reject on that? No, no, no. We go further ahead to assess the further things. Now, one part of base case NPV is done. Now let's look into the issue cost. Working note number two, working note number three. Two was on base case NPV. Three is on calculation of issue cost. Now the particulars. What fund do we have? We have got equity, and the issue cost is there only for the subsidy diced loan. And how much is the amount that is raised? This one is 60 and the other one is 70. They've very clearly specified that the issue cost is at the rate of 2%, and 2% divided by 98 into 2, which is going to be 1.22449, and the subsidized loan again divided by 98 into 2. So the total issue cost is going to be the sum of these. Total issue cost, which is 2.65, is going to be the total issue cost. Now, from the question, we've picked up this point. The issue cost is 2% of the gross proceeds. Now, the next requirement which we need to calculate is the interest tax savings. So there are two interests. We've got the bank loan interest and the subsidized loan interest. Bank loan interest and the subsidized loan interest. So moving on to the next working note number four, which is finding out the present value of tax relief on bank loan. Now, the first thing is that it is very clearly specified here. It is repayable in equal annual installments. Equal annual installments. Now, equal annual installments, the interest rate is 8%. So we will have to find out EAI, the equal annual installment. The equal annual installment, how do we calculate it? It's going to be the loan amount divided by annuity factor. So we need to look at what the annuity factor. Annuity factor of 8% for how many years? The annuity factor of 8% for 4 years, when you calculate, would be 3.312. Now we're going to be using this equal annual installments is the loan amount divided by the annuity factor, and the loan amount is going to be 50 divided by, it's going to be 50 divided by 3.312, which turns out to be 15.096. Now using that in order to calculate how many years, it's repayable across how many years? Across 4 years. 1, 2, 3, 4. The first important thing is getting the opening loan amount, or the opening amount, which is going to be 50. On that 50, how much is the interest at the rate of 8%, and installment, which is going to be 15.0669, and finally the closing balance. Closing balance is going to be the opening plus interest minus installment, and this is going to be the second year opening balance, and second year interest again at 8%. The installment remains the same, and the second year closing balance, which is going to be the opening plus interest minus installment, is going to give the closing balance. Like that, calculating for all the 4 years. It doesn't give an exact zero. Why? Because the discount factor is rounded off. The last year closing balance is 0.00261, and that difference is because of rounding of the discount factors. Now, this interest is going to give us tax relief. The tax relief at the rate of, what is it, 20 percentage, going to give us tax relief. So whatever is the interest, whatever is the interest on the interest, 20 percentage. Pick the interest. How much is it? 20 percentage. 20 percentage is the tax rate. So this much tax relief I have each year. This tax relief is discounted at 8 percentage using KDS discount factor, and 1 divided by 1.08 to the power, having all the discount factors over here, and that's going to give us the present value of tax relief on interest. Multiply the tax relief into the discount factor, and when you total it, the present value of tax relief on interest, or to be more specified, on bank loan. Making this more presentable, select these cells, right click, go to format cells, alignment, and pick wrap text. And then moving on to working note number 4, which is about, yes, only the present value of tax relief on bank loan is done. Now we need to do present value of tax relief on the subsidized loan, on the subsidized loan. Where the particulars, how much is the amount, the subsidized loan, the amount which is 70 million, and the rate of interest which is going to be 3.2 minus, what is it, it's written 50 basis points, highlighting it in the question, at a rate of 50 basis point below the risk-free rate of 3.2 percentage. So it will turn out to be 2.7 percentage, and the interest amount, which is going to be this into this, hmm, and further the tax relief, which is at 20 percentage of this, 20 percentage tax relief on the tax relief, discounted at 8 percentage, which is KD, for 4 years, 3.312, would give me the present value of tax relief, which is going to be 1.25. Again, this can be made a little more organized using the format cell option, and wrapping the text. Next, the last working note. So we are done with what is it? Working note 1, which is the working capital cash flow. Second one, which is the base case NPV. Third one, issue cost. Fourth one, present value of tax relief on interest. And this one on subsidized loan, which is the fifth working note. And finally, the working note number 6, which is the present value of the benefit that we have because of the subsidy benefit. So the after tax subsidy benefit. The last working note, which is how much is that amount going to be? The amount is 70 million, and the interest saved, which is going to be 2.7 minus the 8 percentage, which is 5.3 percentage. And on that interest saved, what is the interest amount? The interest amount tends to be into which tends to be 3.71. And what is the tax relief uh, which is lost, or the tax shield that is lost? We shall lose 20 percentage of this. And the after tax benefit, benefit is going to be 3.71 minus this 2 point discounted at 8 percentage, 3.312. And finally, what do we have? Present value of tax after tax subsidy benefit. Formatting. And now we are done with all the working notes. We've got all the working notes handy, and the last one, which is about using all this to calculate the adjusted present value calculations, and for which the particulars, the from which working note did we pick it up, and then finally the amount. The first one is the calculation of the base case NPV, and then we've got the issue cost, we've got present value of tax relief on bank loan, we've got present value of tax relief on the subsidized loan as well, on subsidized loan, and finally the present value of after tax subsidy benefit. And picking all those from respective working note. Working note number 2, base case NPV, go select that cash flow and it's negative. Next one, issue cost. Working note number 3, go pick that up again, which is negative. Issue cost picked up. Now working note number 4, present value of tax relief on interest, picked up as well. Working note number 5, present value of, and the last one, which is working note number 6, which is needs to be multiplied this into this. all the cash flows selected. Now all the information required for the APV calculation is now available with us. Now how much is the APV? Let us sum all these cash flows to arrive at the APV. And what is the APV? The adjusted present value. The adjusted present value is negative, it is not positive. The most important thing is commenting on this properly and in detail in order to fetch the professional marks. Now, here is a trick to fetch those professional marks. Now, this is one area where the students feel it is very challenging. No, once you have this checklist, you any question you get, you go into it and check whether is there anything that I need to do in communication, is there anything that I need to do in analysis, evaluation, skepticism, commercial equipment. Now, sir, we all know this term, but what to check? Yeah, that is what I'm going to give you. I'm going to give you a checklist. In communication, what are the things you need to look whether whether you can put appropriate heading, subheading, whether you can put things briefly and then explain, follow on, whether you're using clear and concise language, are you putting things into proper working note and appendix, and in evaluation, are you using appropriate data, are you mentioning that further analysis could be done, are you specifying any lack of data, or could probably commenting, giving not giving a biased conclusion, going for a justified conclusion. And as far as skepticism is concerned, is there a questioning approach? Are we challenging the information in the question? Are we stating the problem with the assumption? And are we concluding with a professional judgment? As far as commercial acumen, are we saying that is this thing going to work out in the real scenario? What are the practical consideration that are supposed to be taken into? Are we commenting upon the internal and external environment? And are we specifying about any possible consequence because of any past or the future actions that could happen? Now let's use this hack into the APV question. Let's proceed into the commenting. Comments for the APV. The adjusted present value is negative $3.42 million, and so on these grounds, what is it? It's negative. The project shall be rejected. Now, this is going to fetch me the marks. No, this is not sufficient. This will not help me fetch the professional marks. I need to take this further ahead. I need to bring in what further analysis is possible. What further analysis can I speak here about? I can speak that, what is it? See, the NPV is the negative APV is small. It's not that big. Why don't we look into the sensitivity of the figures? So let's bring in that. And how can I start? What is the connecting magic connecting word that I can use? However, the negative NPV, negative APV is relatively small. Small. And we can suggest, what is it? Sensitivity of the figures need to be assessed. Now, what further? Questioning the scenario, we can state that it is not obvious why the project is terminated at the end of year 4. If at all that time horizon was extended, we could have got a positive APV. So here, let's question that it is not obvious why the project is terminated at year 4. At the end of year 4, we can state that probably a positive APV would have been achieved if the time horizon was extended. Please note, these are just the points that you need to write. It has to be put across in proper sentences. These are just the points. And so this is how we question. And we could also state, speak about the assumption. What about the assumption? More optimistic. They should have taken more optimistic. mistake uh, calculation or most optimistic assumption as far as the operating cash flows and other estimates could have made the NPV, could make the APV positive. What else? We can also speak about the discount factor. Even a very minor change to the discount factor could have made. See, after all, it's very very relatively very small negative. Even a very smaller minor adjustment to the discount rate could have made this a positive APV. So we can even comment upon it. Even a minor adjustment to the discount rate may be sufficient to result in positive APV. And further, in order to fetch the further professional marks, we can, let's bring in the scenario from the question. What is discussed in the question, that the investors, the institutional investors, they are looking or they are recommending to develop new profitable projects, and even though the APV is negative based on their request, if we enter into it, even though this project is negative, what if it gives us opportunity for other new projects, and that other new projects might give us increased future profits? So let's put across the demand of the investors. What was the demand? To develop new profitable projects. Now, even though this one, even though this one is negative, yeah, negative, mm, negative. What is it? It might give new opportunities into other new products, and that other new products could be, might be give us better increased future profits. So this is how our comments are supposed to be. Now when you put across your comments like this, you'll be able to fetch maximum professional marks. Now let's look into the next requirement. The second requirement is about discuss the factors which will influence Fulftig company's credit rating, evaluating the extent to which these will be important to shareholders as well. So the factors that influence the credit rating agencies and shareholders are as follows. What are the various factors? One, profitability, the financing, the operational gearing, the management of the company is important for both credit rating agencies and the shareholders. The political factors is important, and finally, yes, we can mention about the industry factors as well. Now, as far as profitability is concerned, what are the things? See, here in this scenario, the institutional institutional investors, they are encouraging entering into new products. And what does this new products lead to? It leads to more risk, but the more risk is followed by what is it? More profitability. More profitability. Now, credit rating, as far as profitability, is based on what is the sustainability of the earnings? What different sources are they coming from? What is the reliability? So here, based on profit, it assesses what else does it assess? It assesses the sustainability Ability of the earnings. It speaks about the different sources of earnings. It's about the reliability of earnings. Okay, so this is what we can probably, the points that we can mention as far as the profitability is concerned. Now, as far as financing is concerned, yes, the most important thing is that gearing is going to affect the credit rating, and gearing is of concern to both. Gearing affects the credit rating agencies, and also it's of importance to the shareholders. The debt commitments brings in, what is it, of earnings variability of earnings. The credit rating is based on, what is their long term plans to track the finance, how is their relationship with the finance providers, they're also, how are they affected by the debt covenants. So based on couple of points, what points can we bring in? What is the long term plans to attract finance? Are they, how, they'll consider the relationship with the finance providers, and how are they affected by the debt covenants. So this is as far as financing is concerned. Now, speaking about the operational gearing has to be kept as low as possible. We need to keep the fixed cost under control. The lower operational gearing means that the company is going to have higher flexibility. So we need to keep operating cost as low as possible. We need to write about fixed cost being under control. Please note, these are points, bullet points don't fetch you marks. You've got to put it across in full sentences. Now, fixed cost and keeping operating cost as low as possible is both important for the shareholders and the credit rating agencies. And lower operational gearing means lower operational gearing means, what does it means? It means higher flexibility, higher flexibility in terms of, what is it, changing circumstances. Mm. Now, as far as management is concerned, three more things: management, political, and industrial. As far as management is concerned, the experience and their ability, their collective ability, the experience, and, what is it, their collective ability to run the thing is important. Are they complying with the corporate governance? Are things that are of very importance. How are they managing the working capital management? Are they doing it properly? It's actually going to reflect the performance of the management. Now, as far as the political factors is concerned, what is the political stability? It's about political stability. It's about the level of transparency the government is giving us. And it's also about, what is it, the country specific threats. What are the country specific threats? Such as, maybe, the appropriation of assets, remittance controls. So these are things that are politically important. Now, as far as the industry factors are concerned, it's about what is the overall, the industry environment, and that is, this is obviously going to impact, all these are going to impact the credit rating. What is the position in the industry, position of the industry within the economy? position of industry within the economy, within economy. Okay, now that is just one part of it, and the other thing is that what what position it maintains within the industry. So the industry in the economy, the company in the industry. So what position does it maintain in the industry? Is it doing developments to ensure that it is up to date to technology, up to date to technology that is coming up? Hmm? And finally, yes, it is also important as far as how cyclic the industry is. It's also important how cyclic the industry is. So these are things that you need to add on and put it across in full sentences as far as discussing the factors which will influence Fluftig's uh, credit rating. Well, as far as Fluftig is concerned, well, that's it for now. Wishing you all the best for your upcoming exam. This is your AFM expert tutor, Rashad Hussain, signing off. Thank you.